Cash is not likely to be banned. I mean, really what they've been working on is getting us to volunteer the cash. Because if they ban it, then you know things are different. And they really don't want you to realize that anything is indeed different. But frankly, the CBDCs, which is programmable money, will enable them to more easily attack your principal, whether they do it through negative rates or just because of how far away from the period that you can go, that they can, just like inflation was an invisible tax and it eroded the value, the purchasing power value. Mm-hmm. Well, there's basically no purchasing power value left. So now they're going to be attacking principal. But just like we volunteered it with the inflation, they're going to want us to volunteer it with the CBDCs. So they'd really rather have you choose consistently not to use cash. I don't think, and even in the biz money flower, there is a little area for cash, just like there's a little area for private cryptocurrencies. There's a bigger area for commodity money, gold and silver. And then, of course, the biggest area are the CBDCs, the central bank digital currencies. Some retail, some wholesale. And the Biz just recently did a piece where they were looking at the payment systems, and they still show cash as the least expensive form of payment, and which is absolutely true. But, you know, also in my personal strategy, before I saw the digital currencies coming, then I would have, when we went into the new currency system, which is not, the CBDC is not going to be the end-all be-all yet. They have to get rid of the debt. So it's just part of the process of moving us along. But you know, my intention had been to convert not all my gold and silver, because you always need to maintain a portion of that, but, you know, a chunk of it. Now, going into this digital realm, I will be converting a whole lot less, and I will be converting it more as needed, as you said in the second part of the question, you know, on a month-to-month or quarter-to-quarter basis.
Well, just whenever you need it, because if you have income, correct, you're going to be getting paid in the CBDCs, and so you might not ever need to convert it, right?
That's a fact as well.
Yeah, unless you see opportunities, which we always talk about on the other side.
Exactly.
And then you would, at that point, you would convert.
Yeah, exactly. So yeah, I will not be, you know, and I'm very, 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 very clear that this next iteration into the CBDCs will not be the reset, the overnight reset that we're talking about. It'll be part of the transition, but that won't be it yet. Well, you know, typically what happens is you have to have a component of gold in the new currency in order to get the population to trust it. So during the financial system reset, then of course we see it go straight up because they're revaluing something that has no intrinsic value, the fiat money, against something that's all intrinsic value, gold. But I actually see both of them real money, at least for a while, performing reasonably well. I mean, it's all about the reset. And we have to see, because they're also then going to not want you near they're never going to want you near physical gold and silver, ever. Because a rising gold price is an indication of a failing fiat currency. So after that one event takes place, well, as you'll see tomorrow, Venezuela is resetting their currency for the third time. And so actually after that, as they devalue the currency more, then we'll see both gold and silver moving up until we get to the final reset. This won't be one and done. I mean, I can't guarantee that, because that too is beyond my control. But on average, they reset the currency, lopping off zeros 3 times. Until we see a change in behavior, will not be over. What you really want to establish, Troy Ounces, is what your goals are. What are you trying to accomplish? And then it is the right tool for that job. For me, physical silver is about barterability, day-to-day barterability. Physical gold can perform a number of those functions, like we were talking about the real estate taxes, but it's really about wealth preservation. So I definitely do both. I probably, if I had a chunk, I would do the gold because it was easier if I had a chunk. Silver is not as expensive, so it's kind of easier to buy that. So I would have a tendency, I actually have had a tendency, if I had to pick one or the other, to do the gold first. Because it's always easier to buy silver. It's a lot less expensive. The silver is based upon my current cost of living and also my daughter's current cost of living, because that's barterable. But, for me, so that means that as I keep buying, it's like I'm not really buying more silver,
right?
Because I have enough to cover the period of time,
Right.
Yeah, and I kind of go out. Everybody's got to do what they're comfortable with, but I kind of go out a 10-year barterable. I don't think this is going to happen like boom, boom.
Yeah.
The whole strategy is really aimed to survive going through this whole reset, and then on the other side of this whole mess, then being in actually a better position than even when we entered it. So taking advantage of those opportunities. And that is more about gold than that is about silver, taking advantage of the opportunities. So yeah, look at the World Economic Forum as talking about a total, and it is, look, I think anybody that's watching can see this is a complete social, economic, and financial system reset. I definitely believe it's going to get very ugly. So yes, I think we will go local. There will be a period of time where we go very local with our bartering. There is so much incredible manipulation in these markets. And does this portend another recession? Well, how about a hyperinflationary depression? That's what we are moving into. Because to think that the government can be buying up all of these bonds, and there's something really interesting which I'll talk about next week, that's happening again in the repo markets because of all of this massive amount of liquidity that's in there. So when you're looking at the 10-year bond yield falling, remember, interest rates are the biggest tool that central bankers have to regulate the rate and speed of inflation. But they're between a rock and a hard place because there's really no place for the yields to go. Once they go negative, which they, in reality, they're already negative in the US, but nominally, you're still showing a little bit of a positive yield.